This is our penultimate session of the morning, and it is on the very, very significant topic of how family offices are becoming a bigger force in private markets. It's my great pleasure to introduce as the moderator a man who hopefully is a bit more relaxed than he was 48 hours ago, Antoine Coulson, CEO and Managing Partner of IPEM.
Thank you very much, Tim. Good morning. Let's start with this very important and I think attractive theme today. It is extremely difficult to track the number of family offices and their assets under management. We know at IPEM how secretive these investors are, and also how important they are becoming in private markets. Quick fact, you've probably checked that on our My IPEM database. There are about 150 single family offices here at IPEM 22. So it's difficult to track and know how many there are and how much they manage, but there are two very clear findings that I can share with you. First, that there are more ultra-high net worth families and individuals than never before. The 22 Forbes billionaires list, everyone has a look at it every year, is quite clear. There are about 2,700 billionaires in dollars, with a collective fortune of close to $12 trillions. If you compare it, and it's only the tip of the iceberg, if you compare that to insurance companies and pensions assets, each respectively managing around 50 trillion, family offices have clearly become a significant pocket of capital. The second fact is also very clear, just to lay some background, is that the appetite of family offices for private equity and private markets is huge and not declining. Two figures, two recent reports to mention first. BlackRock estimates that the average family office's allocation to alternatives is 35%. And the UBS 22 family office survey mentioned a 21% average allocation to private equity only, and 80% of family offices now investing in the asset class. So this session is really, and I'm pleased to be joined by family officers and investors, because I think it's a hot topic, and it's a pleasure to be joined by you, Nancy Curtin.
Likewise.
Good morning, Nancy. Your partner, Group Chief Investment Officer and Head of Investment Advisory at Alvarium Investment. You tell us a bit more about it.
So Alvarium Investment is a global multifamily office. We started about a decade ago working with ultra-high net worth families and single-family offices. We're going through our own transformation, which is we're combining with the Tiedemann group of companies in the United States. So we will be known as Alvarium Tiedemann at the end of October. At that time, we'll have 60 billion of assets under management, again, working with ultra-high net worth families and single-family offices. And we like to say that what we think is distinctive about what we can bring is that we are in 24 cities, 11 countries, and 4 continents. So we have client advisors in each of those locations that can really understand the client from their jurisdiction, their currency, their DNA, and form that trusted advisor relationship. But we also have 50 investment professionals on a global basis, so we're able to build endowment-style portfolios for our clients. So we like to think that we can bring the personal touch of a family office with the global gravitas of an endowment-style investing on behalf of our clients.
So you represent the multifamily office part, whereas Francesca and Stephen are each representing the single family office part. Can you tell us a bit about the families you're serving and your respective mandates? Stephen, perhaps first?
Sure. I'm Stephen Waprisky, Private Markets PM at Sackville Capital in London. Sackville is a multi-strat global investment advisory firm. We provide investment advice to the assets of a single high net worth family out of the Middle East. Importantly, we're structured as an endowment, so permanent long-term capital that's set aside from the family and managed and advised on by the investment professionals at Sackville. So we're 18 people in London. That breaks down half on the investment team across 3 different strategies. Private markets, which is aimed at primary fund commitments on global buyout on the equity side and credit strategies. primarily in North America and Western Europe, which I'll touch on later, I'm sure. And then we also have a public markets team that makes fund commitments on the liquid side of our business, various hedge fund strategies globally, and a real estate or real assets team. That's the bit that does go direct commercial, residential in Western Europe and North America.
Francesca?
Yes, good morning, everyone. In my case, I come from Spain. The family office is a Spanish family office based in Madrid. Well, I would say in our case, we have direct investments. We invest through funds for sure in all the buckets, all the strategies, private equity, private debt, infrastructures, real estate. And probably it's really known, the family office, because owns important stakes of public companies. For example, names like Gestam, 70% portion. And if we talk about our DNA, probably Gestam will be a good approach. Nowadays it's in 23 countries with 44,000 employees, 113 factories, so we have an important industrial approach. And the owner of the family office is executive chairman. But we are in other direct investments, some I would say known like Wallbox, like Ultra, always in the executive board. So this is a good approach about our DNA. Yeah.
So first question perhaps is to explain why family offices are so much invested in alternative and private markets. I mentioned these two figures, which are huge: 21% allocation to alternative, 35% allocation to private equity only. So 35% to private equity and 21% to... No, that was right, sorry. How do you explain that? It's only matched by the most sophisticated endowments and foundations. Why such an appetite from family offices? Nancy, you want to take that one first?
Yeah, well, first of all, I think many of our families have an entrepreneurial and a business origin in terms of their wealth. And so they really recognize creating value in the private markets. The endowment style approach is important as well, because I say to families, you know, your competitive advantage is in the private markets. There's really no competitive advantage in the public markets. There's nothing you can do. It's largely indexed. The US is very efficient, as we know. It's a very risky market. 5 stocks represent 25% of the index. And if you look at the US by way of example, you know, the public markets are only 1% of the companies, private companies, or companies in general in the United States. So the ability to access the broad swaths of the economy really only happens in private markets. But I think the argument for families is return. Let's face it, on a 5-year, 10-year, 15, 20-year basis, private markets have doubled the return that you can get, particularly the top quartile managers. So one is return. Second is a broader access to opportunity sets. These families like to understand businesses. They like to have access to either buyout types of companies or access to opportunities in the disruptive space, artificial intelligence, quantum computing, machine learning, all sorts of things that you're really not able to access in the public markets. And actually where the value creation, well, we saw what the IPO market was last year. If 100 billion has already been made by the private investors, the clue is you got to get into the private side. So there's return, there's risk diversification, but also I think it's in the DNA of the families to understand private investments and to want to be invested and to understand that that is their competitive advantage to generate with a multi-generational perspective, long-term patient capital. That's really where they can generate long-term returns for the legacy of their families.
Stephen, what makes you think private markets so attractive?
Well, I certainly echo the comments around the ability to take a long-term view. I think that's how we approach our partnership opportunities. We're not looking at yield and income distributions from our private equity program in the next 3, 4, 5 years. I think we're far more multiple focused, and I think that the difference that some family offices are able to enjoy within private markets are around the ability to identify niches and take higher conviction views and build programs in a more streamlined way. I think certainly at Sackville, a lot of our peers would, I think, be in a similar situation where we're not trying to replicate any sort of private equity index per se, but we're trying to identify certain niches, whether that's geographies or sectors, where we have a particular strong view, not again for a 5 to 7 year hold period necessarily, but trying to back managers that we think are sustainable for decades to come. And so I think that ability to take the long-term view and dig it on certain niches is certainly a competitive advantage for family offices within private markets.
Francesc, from your point of view?
Well, in our case, I would say the main target is to diversify. We have a huge exposure in public markets, for sure in just one sector. We have several sectors, but I would say an important sector is the automotive one. So that means, well, we need to invest through other sectors, and a way to do it really fast is through private markets, for sure. And so that would be the main goal. On the other hand, is to get investment through mega trends. We believe public markets are really difficult to get access to these new mega trends, cybersecurity, healthcare. Well, just in I would say in tech, you are able to find even though 50 verticals. So you have to do it, not just through venture capital. You can do it through many buckets, and we are able to do it through private markets, and it's impossible. Just impossible to do it in public markets. And I would say the third skill would be the mindset. Actually, we are entrepreneurs, we are executive, so we feel really well in private markets. We understand the volatility in private markets, we understand the J curve, we understand the private debt, we understand all the products, and we are able to talk really well with the GPs. Sometimes we are even colleagues. However, public markets, you know, the volatility, the momentum, well, we have to be there because we are the owners, but somehow we don't understand so good.
And some families have been investing in private equity and private markets for decades. And what was super interesting when we prepared this session with you, Francesc and Stephen, is that you were relatively early in investing in private markets at some point, and also currently building a program. So I think that's probably very interesting to our audience to let them know, share how you're currently building your respective programs and what your investment principles are. And I'm sure Nancy, as you're building many other families programs, you probably have some comments on that as well. Stephen, perhaps can you tell us how you do?
Sure. So we were set up 3 years ago. I personally joined a year and a half ago. We made our first primary fund commitment in I want to say late 2019. So still a new program. We were always envisioned to be a multi-year program build out. So not necessarily trying to load up on any one vintage, so to speak, but we were always envisioned to be a 4 to 5 year foundational program build out. So certainly looking for diversification in terms of our vintage exposures, sectors, geographies. I think in the North American market, we've gotten comfortable with a sector-based approach. Our particular aim is in the mid-market, I think more specifically lower middle market. Obviously that term is loosely applied these days and means different things to different folks in different parts of the world. But in the lower mid-market, I think even generalist managers in the US tend to focus on 2 or 3 sectors specifically. It's very difficult to effectively cover and attack 6 or 8 sectors as a lower mid-market generalist manager with a 15-person investment team. In Western Europe, we've been taking a more regional-based approach. So again, not necessarily single country managers, but trying to build a nice mosaic that all fits well together in our program construction. We've made partnerships in Benelux, DACH, we're looking at Nordic opportunities, UK. So again, trying to build a complementary and diversified program. But again, having said that, there's not an index that we're tracking towards and necessarily trying to replicate. We're trying to take a high conviction approach of identifying sectors and geographies that we like and have a view on for the long term, and then pick best in class managers to essentially lead our exposure in those themes or niches globally.
Francesc, how are you operating and building your program?
Yeah. Well, in our case, I would say the most important thing is to have that program, to have the strategy. Probably you think, what are you talking about? But in family offices, in my opinion, most of them, at least the ones I know, they don't have really a program. It's like, you are doing different vintages, opportunities, whatever. In our case, well, we define in a program, a long-term program, asset allocation. So that means we have to take into account the cash flow profile we want to. So that means an aggregate cash flow profile for the next 10 years. And that means, well, we have to look for private equity exposure, private debt, infrastructures, real estate, and at the same time, in the family of private equity, you're looking for secondaries, co-investment funds, growth funds, whatever, venture capital, early stage, later stage. In private debt, probably you are looking for mezzanine, for senior. In brownfield, greenfield, if you talk about infrastructures, in real estate, you have a lot of options too. So at the end of the day, the good thing is to know what you are investing and what you are looking for. Because if you don't do that, well, at the end of the day, it would be, you will have a portfolio that you don't want to. The idea is you have to have an actively looking for new GPs, good GPs, the GPs that you want to, and not the ones that probably you will get if you are waiting for them. So I guess activity is really important, and this is the base to have a good program.
Nancy, you're advising hundreds of families. How do you process that?
So we've been doing private equity for over a decade, and I think the first thing starts with access to the managers that have delivered performance to us in the past. And if they've delivered performance, we're going to be a partnership LP. We're going to continue to re-up with them. And having access in those long relationships is super important in a private equity program. Each year, we're going to build a forward calendar and thinking about the managers that we want to have access to. We like to have stage of investment diversification, sector diversification, geographic diversification. For some of our clients, they're buying into a client access vehicle where we have determined what the appropriate asset allocation is across those in a given vintage. For other clients, they have a very, very large private equity program already, and we're building and adding to that on a bespoke basis. Again, it's very, very customized to meet the needs of each client. In terms of what we look for, obviously it's the obvious things. We're trying to find private equity managers who A, have proprietary deal sourcing capability, who B, are truly adding value to the companies that they're buying. And one of the litmus tests is obviously is their profitability and value creation, not multiple expansion, but profitability. Are we driving higher profitability either through global expansion or through cost efficiencies or through M&A playbook? We want to understand the unique playbook that the fund has. And then thirdly, we want to nous around monetization. Our families are long-term, they're happy to own, but they also like to have capital back again. And so we want to see that the partners that we're investing with really understand how to monetize and when to monetize their appropriate valuations. We also like managers that deliver us co-investment opportunities. Many of our more sophisticated families want to be on the cap table. They want to have access to co-investment. They understand that co-investment comes at a lower cost. We like private equity managers who come with zero carry and zero management fee on the co-investment. Let me just put that out there. So co-investment opportunities, and I think we're a credible investor because we can respond quickly. We've got dedicated pools of capital, and we've got families that can add real value to co-investment, global families that have built businesses around the world, and that's really attractive to private equity managers.
Nancy, you mentioned how important the access to the best managers is. What do you think makes family offices an attractive partner for GPs and a special partner, a different one?
So first of all, I think, do you have a credibility of re-upping, which we do. And so I think we form long-term relationships. The second thing is our business is growing. So we're able, I mean, I haven't met a private equity manager who launched a smaller fund. So let me just think about that. So they're growing, they're launching larger funds, we're growing too, and that means we can grow with our managers. That's super important. The other thing is we provide geographic diversification. We have families all over the globe, so we're not sort of one more US LP, let me put it that way. We can provide this geographic diversification. And finally, co-investment. We can be an excellent co-investment and responsive partner. And even though we have an institutional process, we can be really flexible. We can be creative to think about the capital structure we want to invest in, and we can be responsive. The investment committee meets weekly. We don't have to wait for a quarter to think about an allocation. We can be very responsive to a manager or co-investment opportunity, and that's really important in this business. So those are some of the things I think that make us attractive. And finally, we can write a ticket in size, right? So we are probably the size of an endowment if we want to be, and that's important for many of the large, very hard to access managers. Some ticket sizes come 10, 25, and even 50 million for some of the very hard to access venture capital managers, as you know.
Stefan, why would Sackville be a partner of choice for a GP?
Well, I think we're in a unique position where we're building a program from the ground up. And so I think in a time where a lot of LPs that are well-established, either pension funds, sovereigns, or more well-established endowments than we are struggling, frankly, to meet that pace of re-ups and be there for the next generation of funds and continue that long-term partnership. I was sitting in on some sessions a couple of days ago, listening to some pension fund managers speak about managing hundreds of different GP relationships globally with thousands of underlying portfolio companies. very difficult to have strategic relationships and genuine long-term engagement, I think, with that volume of relationships. We're building a program, a high conviction program that, again, is fairly streamlined yet diversified. We're trying to get to somewhere in the high teens or low 20s in terms of our number of GP relationships globally. And philosophically, we try to do more with fewer. So whether that means being there for successor funds, I think whenever we start conversations, we're not just looking at the current fund generation, we're looking at ideally being there for N plus 1, 2, 3, et cetera. So long-term partnerships. The co-invest side is, of course, somewhere we have aspirations to add value down the line as well. And I think when it comes to LPAC seats, that's obviously a strategic engagement that we try to have too. But I think on our side, trying to do more with less is really resonating, as well as growing a platform from essentially a blank piece of paper on the private market side 2-3 years ago.
Francesca, I know you're investing with some VCs that are known for being difficult to access to. Why? How do you get access to these firms, and what makes your family office a partner of choice?
Well, I would say, a long-term relationship before, even though the family office, this is the network is really important within the time. On the other hand, we've been important investors in venture capital for long-term, the family, so that makes you a good access. At the same time, we are somehow, I would say, deal origination platform, because we have these relationships, even though we, the owner is in several associations too, like Endeavor, Catalyst, and others. So that makes you the facility to get through different access. And I would say somehow this industrial approach that we have, an entrepreneur approach that we have, gives us a lot of possibilities. In some cases, we enter in with our investments in some venture capitals, but anytime they need to get into to get more money, always they are calling us. They spend a lot of time. They explain all the companies they want to invest, because they know normally we like a lot to go through co-investment. So we are able to invest more on a bigger amount, even though, than we have invested through the fund. So I mean, if you invest 1 million, 20 million, whatever, if we understand the company, like we have this, not just financial approach, it's easier for us. So always, a lot of times they are calling us, would you like to put the part that we are not able to put? Because for mandate, imagine you just can have, they can have the possibility to invest 30 million, but they want to invest 70 million. So they need some colleagues to go with them, and this is, I guess, the main target for them. Yeah.
I think we have about 5 more minutes, and there are 2 trends I'd like to cover with you to close that session. 2 big trends, I think, for family offices. One is their interest for direct investments. Sometimes, often perhaps, investing in funds is transitory for some family offices. As entrepreneurial organizations, that tend to lean to direct investments quite fast. Is that your case? For example, at Sackville, are you interested in going direct?
The short answer is yes, eventually, but we're very conscious of not putting the cart before the horse, if you will, in that department. I think there's certainly an allure at a lot of family offices and other types of LPs, where there's a belief that outsized returns are available with direct co-invest. But I think there are, I think statistically that does not prove to be the case in a lot of LP platforms, where you might chase co-invest for relationship purposes, and then they actually end up underperforming your fund commitment program, which doesn't really make sense, but actually is the case after fees and carry, et cetera. And there are a few key tenets, I think, that are important to get in place that we're certainly working towards over the years, not just the next couple of months. But first is getting the right strategy in place, so clearly defining your strategy in terms of what your size, your business model, how many GPs you're willing to back. Is it going to be purely captive and alongside your fund program or not? Are you willing to entertain outside conversations and potentially source direct co-invest directly outside of the funds program? And I think having those clear lanes avoids tripping up and making maybe quick decisions based on relationships. Second is on the talent attraction and retention. I think it's quite difficult for a lot of, potentially more so on the pension fund side, but having the right incentive systems in order to attract and retain talent that will be with you for the long term, i.e. decades, is quite important. And then from a systems and monitoring and performance measurement perspective, having the right internal infrastructure in order to measure performance and then decide where to lean in and direct co-invest with your GP relationships, or certainly examine re-ups down the line. I think a lot of family offices are lacking in the basic infrastructure as well to measure performance. So long way of saying we are interested, and that's one of the ways that we hope to be strategically engaged with our GP relationships, but we're very measured and want to do it when it makes sense and we have the flow and right internal infrastructure to support those initiatives.
Nancy, you may want to comment on that direct part, but there's also another trend that I wanted you to comment is impact investing.
So we're probably the largest impact investor. We have about $6 billion of dedicated impact mandates. And I want to start by saying our impact investing is not a product. We start with the family. We start with the next generation. It's a very iterative discussion about what it is that you're trying to accomplish, what's your programmatic area of interest, what's your mission, what are you passionate about, and only when you identify that do we then build a bespoke program for our families. It's largely in private markets because they understand that's where they can access most of the opportunities. So we build a bespoke private equity within the impact space. Two themes, accelerating the path to net zero, so climate solutions, environmental justice, and obviously carbon sequestration. And the second theme is societal, trying to improve this inequitable society we live in through, financial democratization, access to healthcare, global education, exactly, innovation in those areas. In the impact space, we are willing to invest in younger managers. There aren't very many 10-year vintage impact, credible impact managers. So we are willing to invest in earlier stage managers. As a matter of fact, our families want to invest in earlier stage managers because they want to get capital to areas that are making a difference. I would say the really interesting thing about impact with families, they care about the impact first and the market return second. Number two, they want to do it together with other families. They care about investing together. And we've got a lot of forums where families in common programmatic areas of interest can co-invest together because they understand that combined capital is going to have even more of an impact. And finally, we understand this is an evolving space. We are co-creating together. We're learning from the families are learning for us, and we continue to have education forums because no one's got the answer on reporting or what you need to do or the key trends. And so bringing families together that have a strong interest in this area is a really, really fantastic way to cement relationships, we think, and continue to develop an impact.
Thank you, Nancy. I think we are a bit over time. Thank you, Francesca and Stephen. For these remarkable and very interesting insights about your investment activities.